20 if you haven't already. So if you already have and you remember your score or like just generally, you can either do it again or wait. So on your book, I think Growing Money. Yeah, here. On page 20, there's a personality quiz. So could you guys do it now? Yeah, and after a moment, we're gonna like share your scores. After you've completed your quiz, tally up your scores on page 23. Max, do you have a question, by the way?
I just wanted to like tell my score, but like I can wait.
Okay, first of all, has anybody done your personality quiz yet?
I have.
Okay, so who hasn't done your personality quiz yet?
I haven't.
I haven't either.
I haven't.
Well, that's good. I'll just give you like 2 more minutes and then we can share our scores. Okay? Okay. Is any like do you guys need more time or are you guys done with your quiz?
I'm done.
Okay. Have you tallied your score? Like, because on page 23,
Yeah.
well, I'll just wait like maybe 1 or 2 more minutes for the rest of you guys to catch up, and then we can share our scores. Okay, is everybody done with the quiz?
I'm calculating my score, so like 1 minute.
Okay.
Two. Three,
Okay, you're
two,
done?
mm,
Okay, let's just start. So does anybody want to share the scores? Max?
So I got a moderate.
17 plus 5.
So I got a
Me too.
moderate. Hello. I got a moderate risk taker. As my final score, and I think I got something like 30 something. I believe 38. Or was it
Oh, that's
wrong?
great. That's great, Max. Chloe?
I got a moderate risk taker, but I'm not so sure what my score is. Maybe like I'm not so sure. So yeah.
Yeah, that's good. Tristan?
I think I got moderate risk taker with like 20 points.
Mm-hmm. Yeah, that's cool too. I mean, like, there's no right or wrong with this. It's like, this is a personality quiz, okay? So there's no right or wrong if you get like risk level or moderate risk taker or risk avoider. So Aurora,
I got a 29 for moderate risk taker.
mhm. A lot of people are getting moderate, probably because Isabella,
I got 28 for also moderate risk taker.
mhm. That's great. Daniel,
I got a risk avoider. I think.
cool. How many points was it? Or do you lose track?
I forgot.
Well, that's great. Alisa,
Well, I also got moderate risk taker, but then I got a score of 31.
oh yeah, that's kind of close. Oliver,
I got moderate risk taker.
yeah, I think like a lot of people like, I guess like most people are like moderate risk takers because a lot of people are in between. But like it's like it doesn't really matter, I guess. It's just like your own personality. I got moderate risk taker too. I got 25 points, I think. Yeah, I got 25 points. So now let's do the chapter 3 to 4 questions. There's kind of, well, there's only 4 questions, but yeah. So what is a CD? And I don't mean those like plastic disc thingies that you get from stores. Like, Chloe?
I think it's type of bank account.
Yeah, great. Do you remember like how it works or anything? Or like what's its name, like fully written out?
I don't think so. No, not really.
Okay, well that's great too. Alisa, Alisa?
I forgot the full name, but I know that it's like a kind of like a bond or something, but you have to keep it no, you can't withdraw your money for a certain amount of time, but there are higher interest rates.
Yeah, exactly. That's basically what the CD is. Tristan, do you know what like its full name is, or do you just?
I think it's certificate of deposit.
Yeah, excellent. So basically, a CD is a special type of savings account called a certificate of deposit. How it works is that it pays you like higher interest rates than normal savings accounts if you promise like you don't take your money out after like before a certain period of time. So this is also a kind of open question. It's like a follow-up question. Would you personally invest in a CD? Like not invest, I guess, put your money in a CD. Max?
Yes, because like it's generally better in long term simply because like it is definitely quite a bit higher than interest rates with interest. No, not interest, inflation, which is currently 3%. And CDs usually are more than that, especially if you find a good place to put them. So you can and it's also really stable because like you're really because like it's considered really low risk. But like if you're going into retirement, you might invest in a CD because so then you're like, no, okay, so this is when I retire, and then you have a lot of time.
Yeah, cool. Kristen?
For me, I think it depends on how long the period of time is where you have to keep your money in the account.
Mm-hmm. I mean, like, I personally wouldn't invest that much money in a CD because like I would much rather invest in like the stock market or real estate or anything else. But like if I was going to open a savings account, which I probably would, I would like take some money aside to put it in a CD. So question number 3, what are a few important ways savings banks are unlike piggy banks? And I mean like important ways, not just really obvious ways. Because of course, yeah. So Chloe?
So like banks are like saving banks. Well, might be kind of obvious. Saving banks offer APY, I think, and then piggy banks probably don't. And then saving banks keep your money like safe, and piggy banks don't. Yeah,
Yeah,
well, can, but like saving banks are more safe.
good. Like okay, those are really good. But when I mean don't say obvious ways, I mean like don't say that piggy banks are shaped like pigs or anything or pink or whatever. Like those aren't very obvious. But Isabella?
I don't really know if Chloe said this, but interest, so your money grows. If you put it in a saving bank, if you put it like in the piggy bank, then if you had $1, it might decrease in value.
Yeah, good. In fact, just don't mind me when I said obvious, okay? Just pretend I never said anything. Kristen, do you have like any different answers?
Money and piggy banks are easier to access, so I guess if you put your money in a saving account, it's easier to like control the amount of money you spend.
Oh yeah, that's a really good reason. Um, yeah, so a few important ways savings banks are unlike piggy banks is that savings banks saving banks pay you interest. Number one, as I think Chloe, Lee, and who else? Elisa, Aurora, was Amy? Someone else said also like savings banks, you have to actually go to an ATM or to the bank and withdraw it, or like if your savings banks is online, you have to actually withdraw the money, and it's slower than actually just taking out your money from your piggy bank. Also, your money isn't actually in your building, like if like with savings banks, because those banks just invest your money. They don't really keep that much money in the building. Like unlike piggy banks, the piggy bank, like the money is just inside the piggy banks. Also, Max, did you have like an answer, or did you just forget to raise your hand? Okay. You know what? If you like answer the question and you like and you answered it, could you please just like unraise your hand or anything? So question number 4, if you are choosing a bank to open a savings account, what are some important factors you would want to consider? Elisa?
So basically, first, I want to make sure that the bank is reliable because, like, even though I only have like $3 to put in my savings account, I still have to make sure that it won't go away. And also, I need to check the interest rates so I can grow my $3. So, yeah.
Yeah, that's a really good a factor. So Chloe?
I would like to know if they have like a FDIC, like if the bank closes, then I would say like if the government like yeah. And then as she said, I want to see the APY too. And like how trustworthy it is.
Yeah, those are both like really important factors, as Lisa and Chloe said, because it doesn't really matter how much money you earn or you have if your bank isn't trustworthy, or like if you end up losing all of those money. So Isabella?
I would want to know if I would have to pay a monthly fee if I had less than a certain amount of money in my account.
Oh yeah, monthly fees. Those are really important factors too. Yeah, that's excellent, Isabella. So if I were choosing a bank to open a savings account, some important factors I personally would want to consider, like if the bank's trustworthy, if the interest rate is high or not, like the convenience, like if it takes forever to withdraw or deposit money into the bank, then I wouldn't really want to open a savings account in the bank, like if it took like a week or anything. Also, I would want to consider some like monthly fees, like if I have a certain amount of money, how much, if I had this certain amount of money, if I would have to like pay some fees, or if I would have to pay fees for, I don't know, consulting someone. So yeah. Okay, let's move on to the chapter 5 questions. What is an IOU? Isabella? That was quick.
So basically, the part I remembered is just means like I owe you personally. Like if you borrowed money, then like you just owe that person money. So
Yeah, basically. Yeah, that's good, but like, I mean, like, yeah, but what's an IOU and like more of like a definition? So does anyone know what an IOU is besides like something that's saying I owe you something. Isabella?
Okay, sorry. I just flipped to the page again, and basically, the IOU from a student government is like from some place, like the author said Ideal Town. It's called a bond certificate.
Mhm.
Like it
Yeah.
tells you
Mhm.
like important things about the bond.
Yeah, great, Isabella. So an IOU is basically a bond certificate that tells you all the details about the bond. And so a follow-up question, what things will an IOU or like a bond certificate tell you? Let's see. Since you've had your hand up there for a long time, I'll call on you, Chloe.
The bond certificate in the book, it says face value, it tells value or par, it tells maturity date, coupon rate or yield, coupon payments.
Yeah, that's really good, Chloe. Well, that was basically what I was gonna say. But yeah, wait, were you looking at the book?
Yeah.
You you sounded kind of robotic. But yeah, that's basically what a bond certificate would tell you, along with like maybe some other minor, not that important details. So, question number 3. By the way, I think this chapter is all about bonds, right? Anyways, question number 3. Why do corporate bonds usually have higher rates than government bonds? Isabella?
Because the companies may or may not pay you back. So like it's high risk, so many people don't want to invest in it or something. So then the company people, they have to higher the rate so that if you invest, they'll like pay you more money, I think.
Yeah, that was stated really well. Well, there's not a lot of other explaining to do, but so let's move on. To question number 4. What is a good thing about municipal bonds? Does anyone remember what a municipal bond is? Chloe?
What question are we on? Sorry.
Okay, you know what? We're on question 4, and I'll allow you some time to think about it while I ask Oliver. Okay? So do you have an answer? Oliver?
The municipal bonds, you don't have to pay taxes. And the municipal bonds.
Yeah, that's basically what the good thing about municipal bonds is. Because like while municipal bonds, I think gives you like lower interest rates, there's no tax on the interest from the bonds. And so question number 5. How do Treasury inflation protected bonds, TIPs, I think, protect you against inflation? Let's see. Alisa?
So basically when inflation becomes higher, your money will also grow according to how much like inflation there is, I guess.
Yeah. So yeah, that was stated really well. So what kind of bond, and this is the last question for chapter 5, okay? So what kind of bond is the series 1 bond? Well, no, this is the second to last question. Let's see. Chloe?
So like on the book it says series I bond is purchased at like the face value, full face value, and then there's interest added like when the bond matures to the amount.
Yeah.
And then do I answer second question?
No, you actually didn't. I actually just wanted you to say what the Series 1 bond is, but it's okay, I guess. Well, does anyone have like, but that's really good, Chloe. Does anyone else have like a more detailed version of what Chloe was saying? Okay. Well, Series 1 bond is basically a savings bond. And as Chloe just said, it adjusts its interest, it adjusts its interest after 30 years. So basically there's a fixed interest rate for like 30 years, and then there's additional like interest that adjusts every half year based on the inflation rate. So does anyone have any questions about this? Or like, does anyone have any questions about this so far?
Wait, is force face value like the value of the bond, like the value of the bond?
The what is the what?
Is force face for face value the for value of the bond?
Yeah, the face value and the for face value is basically the money you get if you hold the bond till its maturity date. So yeah, it's for face value is basically the same thing as face value. It's just like a more fancy way of saying it. So does anyone else have any more questions? Because like some of these chapters, especially chapter 5, can be kind of confusing. Okay. No? Okay. So now let's move on to the case study. Part 1, okay? So just hold on with me until I get to the end, okay? Because this might seem kind of random at first, okay? So suppose today you buy a 30-year treasury bond with $1,000. The bond's yield rate is 3.88%. So after 30 years, when it matures, how much money will you get? And the yield rate is simple interest. Does anyone know how to compute that?
You can use a calculator. Okay.
No, like the formula or whatever.
Maybe like first find the yield rate, and then after that, like find the yield rate for 1 year, and then find it for 30 years, and then maybe add it from the original, and then you get it.
I don't have a calculator with me right now, but
No,
it's supposed to 0.88% annually. So could do math.
Yeah.
But I don't.
Like when I mean calculate that, I mean like the equation or something, or an expression or something, not like actually calculated. Okay, well,
Because I can say if it's the equation, well then it would because it's 3.88% annually, so it's 1,000 times 0.0388. And then you do that, you parentheses that, and then times 30 because that's annually. So for 30 years after it matures.
yeah, you mean times 30, right?
Yeah, times 30 because it's not compound.
Yeah. Well, I mean, I didn't really expect you guys to answer this because a lot of you won't know how to calculate this, but I'm just gonna review. Oh, by the way, Max, you add 1,000. I forgot to tell you. But anyways, this is the equation for it. So I just skimmed through this. Like the result is $2,164 after 30 years. So you see that this is the original money, right? Plus this thing is this is the original money, plus this thing is this group of calculations. of or like multiplications is the yield. So it's 100, I tell 1,000 times the yield rate times how many years. Because this thing is basically like the yield after 1 year, right? And you have to multiply it by 30 for 30 years. So then you get like the yield of it, like the interest plus your original $1,000. So now this is part 2, okay? So clear everything else from your mind. Let's say you have $2,164 after 30 years, right? After you got the 30-year treasury bond. So suppose the average yearly inflation rate is 3.2% over the 30 years. How much is $2,164 after 30 years worth today, like in dollars? Like,
Wait, did you bought the treasury inflation protected securities, or did you bought the treasury notes or like treasury bonds?
what?
What do you like? Did you bought the tips like TIPS, or did you bought the treasury bonds?
Just the treasury bonds. Okay. Basically, $2,164 is after 30 years is what. Oliver, do you have a question? Do you have a question, Oliver?
I got $2,164 is $841 if the inflation is compounded.
Oh no, wait. Okay, sorry, maybe you misunderstood me. That might be correct. I mean, like, how much is $2,164 after 30 years worth in dollars today? Because it's inflation, right? So $2,164 would buy the same things after 30 years after, let's say, like how much, like, what else? Well, wait, hold on. $2,164 after 30 years is worth $841 today. So $841 today can buy the same things as $2,164 after 30 years can buy. So let's say you buy a television for $841. As long as like televisions don't become really scarce and there's no like rush to buy it or sell it or whatever, you can only buy $2,164 for that same television. Well, no, that isn't very clear.
But because you started off with $1,000, and then essentially after 3 years you lost money because inflation is compounded.
Yeah, exactly. Well, come on, I was about to say that, but okay, yeah, that's great, Max. So look at the results again. After putting $1,000 in a treasury bond for 30 years with an annual yield rate of 3.88%, you get $2,164. But due to inflation, that $2,164 after 30 years is only worth about $841 today. So because of inflation, you're essentially losing the money that you invested. So do you guys have questions?
Actually I do. So you're saying that the bond is not compounded, but currently some banks will pay 4% interest. So wouldn't like investing in a bond not even be as worth as a bank because 4% is greater than 3.2%?
Yeah, because this is simplified interest for the bond. Many bonds, well, most bonds have simplified interest rates. But of course, note that here in this example, the inflation is really high. normally inflation wouldn't be that high, but for the purposes, we just made it high, okay? But
Actually,
like,
it's 3%, so it's 0.2% off.
yeah. Yeah, but like we're just like simulating like a higher inflation economy because sometimes like if there's a recession or if there's a recession, inflation rates will go up a lot. So we're just simulating this, okay? So in peaceful economies where the inflation rate isn't very high, then investing in bonds is like will give you positive returns and will be worth it. But in like a really disastrous economy, investing in bonds isn't that worth it. Of course, bonds have good things because like overall, I mean, bonds overall have overall in the long term will still give you money as long as your economy isn't in a big recession, and bonds are usually pretty stable too. So most of the times it was still like you will still end up with about this same amount of money, but bonds still won't give you that high returns because there's inflation. And yeah, so based on this, is it wise to invest in 30-year treasury bonds? Or like would you invest in 30-year treasury bonds? Why or why not?
Probably not, considering that this bond isn't even paying as much as for inflation. Because like if you're gonna invest, like at least get it above the inflation.
Yeah. Yeah. Also, I forgot to say something. Like this TIP, this tips, right? Treasury inflation protected bonds, and like you can like buy those, but they still won't give you very high returns because TIPSs, they usually have very low like interest rates or yield rates. So overall, yeah. So Chloe, do you have do you like would you invest in 30-year treasury bonds?
No, because like if you invest in stocks, you probably will earn more money in 30 years. And like I guess maybe you would earn like 1,000 from like 30 years ago to here probably be less than 800, but like still not a not a really good return. So like if you like the stock market usually has like about average annual return of 8%. So I think it's better investment to invest like in stock market or like real estate.
Yeah. Great. Oliver?
I don't think it's wise to invest in 30-year treasury bonds because you only get like $1,000 in 30 years without inflation, and also with inflation, the money is literally worth less.
Mm-hmm. Yeah, that's interesting. Isabella?
I personally wouldn't because I'd lose like 100, like almost 200, not really dollars. I would rather put it in an inflation protected savings account thing.
Yeah. So Kristen?
I don't think it's wise to invest in 30-year treasury bonds because while you may technically earn more money, that money, because of inflation, will be worth less than it would have 30 years ago.
Yeah, that's basically like my conclusion, and a lot of people would come to this conclusion too. Of course, here the inflation is like 0.2% higher, but of course it doesn't make that much of a difference. And like in a normal economy, you still would lose some money, like in the 30-year treasury bond. So while it's like more stable than like high risk stocks or anything, you still know that your like investing in 30-year treasury bonds without inflation protected stuff will still like you still end up with around the same money, maybe a little bit less, because like overall normally you'll end up with less than you have before investing. Of course, if you didn't invest, you probably would your money probably would decrease even more. So I don't think it's very wise to invest in 30-year treasury bonds. Of course, some people they invest in 30-year treasury bonds to help their government or something. Like they invest in 30-year treasury bonds and like they might lose a little bit of money, but like theoretically it will still help their country a bit, right? So or not, investing in 30-year treasury bonds is not worth it. Like, of course, this is opinionated, okay? But in my opinion, it's not worth it. As proof, you actually lose money when you buy those bonds. Max?
So the question which asks what kind of assets should you invest in? I was gonna ask that.
Okay. Well, might as well. So my question is, what kind of assets should you invest in then? Or what kind of assets do you want to invest in?
So ETFs, though you generally want to diversify ETFs because they're generally based on sections. So if you're all investing into technology section and then suddenly like technology section like completely fails, you're gonna lose a lot of money. But like you should probably do some ETFs, some stocks. Sometimes if you do have a good bank, you can sometimes put it in a savings account that has a interest rate higher than the current inflation. So the PNC Bank, SoFi, like smaller banks generally they give a higher interest, and you can also invest in real estate. And now the book, like the previous book, did say that real estate is overrated. I personally don't think it's really overrated. But like if you're really trying to do long term like real estate, yeah.
Yeah, that's an interesting point. So Chloe?
Maybe I invest like in index funds, ETFs, and like diversify my portfolio. I might follow the David Sweden's portfolio and stocks, like real estate. Yeah.
Yeah, that's great too. Does anyone else want to share their opinions? Okay. Well, thanks for sharing, Max and Chloe. Like the kind of assets I would invest in is mostly like stocks, maybe a few ETFs or index funds mixed in together. I would also invest in some others. I might invest in like a few bonds, like maybe TIPSs or treasury inflation protected bonds or stuff, but I wouldn't invest in them a lot, and I would only invest in them by the time I was like 40 or 50 years old. Right now, I would mostly invest in stocks and I would mostly invest in the stock market because like I'm only 11. I have a lot of time left, and yeah, I think it's kind of it's important to like diversify